What if the most valuable company in financial markets isn't the one making the trades, but the one making those trades possible? Every second, buyers and sellers from around the world exchange billions of dollars in digital assets. Yet behind every completed transaction lies an invisible system coordinating orders, managing balances, verifying identities, processing payments, and maintaining market activity around the clock. Modern exchanges don't simply provide a place to trade. They build the infrastructure that keeps liquidity moving. And in today's digital economy, controlling that infrastructure can become far more valuable than participating in any single trade. Traditional financial markets were built around business hours, geographic boundaries, and centralized institutions. Digital exchanges changed that model completely. Today, capital can move across time zones, currencies, and asset classes with almost no interruption. The market no longer closes when a city goes to sleep. It becomes a continuous global network. This shift is more than a technological upgrade. It transforms liquidity from a local financial resource into a constantly available digital service. Every exchange has a business engine, and in this industry, the engine is transaction volume. The platform becomes more valuable when more people trade, more assets are listed, and more liquidity is available. Higher activity attracts additional participants. More participants create tighter markets and better execution. Better execution attracts even more activity. This feedback loop is what turns a trading platform into a scalable network business. The exchange is not simply monetizing trades, it is monetizing the flow of liquidity itself. Business engines create value. Architecture allows that value to scale. When people look at an exchange, they usually see charts, prices, and order books. But beneath the interface lies a much larger operating system. Matching engines coordinate buyers and sellers. Wallet infrastructure manages digital assets. KYC systems verify identities. Payment gateways connect financial networks. Security layers protect accounts and transactions. Administrative tools monitor the entire ecosystem. These components are rarely the reason users join a platform, yet they determine whether the platform can operate reliably as liquidity grows. The visible market is only the surface. The invisible architecture is the real exchange. Let's connect these ideas to a practical implementation. Today's architectural blueprint is Vinance, available on Envato Market. Rather than treating it as a complete exchange business, view it as a reference architecture, illustrating how liquidity management, wallets, trading interfaces, user verification, and operational workflows can be organized into one coordinated system. Studying architectures like this helps entrepreneurs understand how exchange businesses are structured before deciding how to differentiate them for specific markets or communities. Let's examine this platform through the lens of business architecture instead of software features. At first glance, it looks like a cryptocurrency exchange, but beneath the interface is an operating system designed to coordinate users, assets, transactions, compliance, and financial operations simultaneously. Every module exists to reduce friction between buyers and sellers. Wallet systems manage digital assets. Trading engines process market activity. Administrative dashboards monitor the ecosystem. The software itself isn't the business. The business is the infrastructure that allows markets to function continuously, securely, and at scale. Notice what the platform is truly designed to encourage. Every completed trade contributes to market activity. As activity increases, participants experience faster execution and deeper liquidity. Better market conditions attract additional users, who in turn generate even more activity. This self-reinforcing cycle is known as a liquidity network effect. The exchange doesn't create value by predicting the market. It creates value by making the market more efficient for everyone participating in it. That's why successful exchanges compete to become the preferred destination where liquidity naturally concentrates. Many people assume an exchange succeeds because it owns valuable digital assets. In reality, the greatest value often comes from owning the infrastructure where those assets move. Exchanges rarely need to issue every asset they list. Instead, they build the systems that connect buyers, sellers, liquidity providers, payment channels, and operational controls. As participation grows, the infrastructure becomes increasingly valuable because more economic activity depends on it. In platform businesses, facilitating value creation can be more powerful than owning the underlying products.
Vinance is one example within a much broader category of exchange platforms. Similar architectural principles appear across cryptocurrency exchanges, stock trading systems, commodity marketplaces, foreign exchange platforms, and other financial networks. While their interfaces and target markets may differ, they rely on the same underlying patterns: coordinating participants, maintaining liquidity, processing transactions, and building trust through reliable infrastructure. Once you recognize these recurring principles, you stop evaluating exchange software based only on features. Instead, you begin evaluating the architecture that supports sustainable financial ecosystems.
History shows that the most influential companies are often not the ones producing the assets people want. They are the ones building the infrastructure that allows those assets to move efficiently. Railroads accelerated industrial trade. The internet accelerated information. Digital exchanges accelerate capital. Every improvement in financial infrastructure reduces friction, increases participation, and expands economic activity. The greatest opportunity isn't always owning the asset being traded. Sometimes it's owning the system that allows millions of people to trade those assets with confidence. If you're exploring opportunities in financial technology, don't begin by asking which asset will increase in price next. Ask a more fundamental question: what infrastructure enables that market to exist? Every successful exchange solves the same challenge. It connects buyers and sellers, manages liquidity, reduces friction, secures transactions, and builds confidence between participants. The asset class may evolve over time. New technologies will emerge, regulations will change, but the need for trusted financial infrastructure remains constant. Businesses that enable markets often outlast individual market trends. If today's architectural blueprint gave you a new perspective on exchange businesses, you'll find the reference link in the description below. Explore the live demonstration, study how the platform organizes trading, wallets, user management, and operational workflows, then compare it with other exchange platforms available on Envato Market. Remember, this isn't about finding a single perfect product. It's about recognizing the architectural patterns shared by successful financial platforms. Once you understand those patterns, you'll begin seeing opportunities that extend far beyond any single technology or market. Behind every financial market is an invisible architecture that makes trust, liquidity, and global participation possible. Markets may rise and fall. Technologies will continue to evolve. New asset classes will emerge. But the systems that coordinate people, capital, and confidence will remain the foundation of the digital economy. That's why this series isn't about reviewing software. It's about decoding the invisible architectures that quietly shape the businesses of tomorrow. If you enjoyed today's episode, subscribe and join us as we continue exploring the systems behind the world's most powerful business models. Until next time, keep learning, keep building, and remember, wealth is not built by working harder. It's engineered through systems.